You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's August 18th, 2026, and this week on Uranium Spotlight, a quiet spot market that keeps grinding higher. Why the people who report uranium prices think utilities need to start listening, the slow Western retreat from Russian fuel, another block of Kazakh pounds heading east, and the mining giants circling the Athabasca Basin. Spot activity was thin again last week, which is what August usually delivers, and yet the price moved anyway. The week opened at $86.40 a pound U3O8 and closed at $87.40 a pound U3O8, a dollar higher across 5 sessions, in which only 4 transactions were confirmed. 3 of those called for prompt delivery inside the 0 to 3 month window, and the last of them came late Friday afternoon when a seller finally stepped forward to hit a bid for 100,000 pounds with delivery at Coverdine just before the close. That is a market where the buyers, not the sellers, are setting the pace. Bids drifted upward through the week as buyers slowly revised their prices for prompt material, and the sellers who did transact were reacting rather than leading. When a price rises on almost no volume, it tells you the available pounds are not sitting on a shelf waiting to be sold, and prompt material in particular has become genuinely scarce. Underneath the daily noise, the long-term price held at $94 a pound U3O8, and that's the number that actually describes the industry. Term activity stayed limited last week, but the queue of unfilled demand keeps building. One American utility is waiting on offers for up to 400,000 pounds a year for delivery in 2030 through 2034, and another 300,000 pounds a year beyond that. A non-American utility is reviewing offers on roughly 500,000 pounds a year for 2027 through 2031, and at least 3 more are working through requests for information covering deliveries that stretch into the 2040s. The World Nuclear Association Symposium is only a few weeks away, and a good deal of that quiet demand is likely to surface there. The takeaway for investors is that summer stillness in the spot markets is not the same as an absence of demand. It simply means the demand has moved into rooms where the pricing is negotiated rather than posted. Anna Brinza, Executive Vice President of International, one of the nuclear sector's leading market research firms, gave an interview last week to World Nuclear News, the news arm of the World Nuclear Association, and her message was unusually direct for someone in her position. She said that price reporting matters more now than at any point she can recall, and that reactor operating utilities need to start listening to what those prices are telling them. Her view is that every segment of the nuclear fuel cycle is heading into a supply deficit, but that uranium mining is in especially deep trouble. She listed the reasons without much softening: supply disruptions, geopolitical risk, trade actions, construction delays, and rising production costs. What makes her comments worth pausing on is her emphasis on the links between the segments of the fuel cycle, rather than on any single bottleneck. A conversion shortfall and an enrichment shortfall and a mining shortfall are not 4 separate problems that a utility can address at one time. They're one problem expressed in 4 places, and prices are the mechanism by which the strain in one segment shows up in the others. Her warning is that without serious intervention to stimulate production in the mining sector, there will be real deficit of U3O8 in the years ahead, and there is a reasonable argument that the deficit has already arrived. The evidence is in the long-term price, which has been climbing steadily, and the long-term price is the honest indicator of where the mining industry is headed. The spot market handles somewhere between 5 and 10% of the uranium that changes hands, and most of that flow does not go to utilities at all. It goes to financial institutions and investment vehicles that are buying uranium as an asset rather than as a fuel. Uranium equities have been slow to reflect any of this. They've lagged the commodity, and they've lagged the contracting cycle that sits behind the commodity. But the arithmetic of a structural deficit does eventually reach the companies that own the pounds. Investors who have been arguing this thesis for years may find the argument finally starts making itself. Western governments have spent years trying to unwind their independence on Russian energy, and the contrast between how fast that happens in oil and gas and how slowly it is happening in nuclear fuel is one of the more revealing facts in the market. Oil and gas were largely severed within months of the 2022 invasion of Ukraine. Uranium has taken far longer, for the simple reason that a reactor cannot switch suppliers the way a refinery can. The United Kingdom banned imports, though it was never heavily dependent to begin with. The United States also enacted a ban, but wrote in a waiver regime that runs until 2028, and under those waivers, American utilities still take somewhere between 20 to 30% of their enriched uranium from Russia. The one clean break is in the U-308 itself, which has not come from Russia since last year. Europe has moved even more slowly. European utilities still source over 40% of their enriched uranium and 16% of their U-308 from Russia, and the formal ban that has been discussed for years remains unfinished. Progress was long complicated by Hungary, whose former leader, Viktor Orban, was reliably positioned to veto, and while his loss in the May election removes an obstacle, any Hungarian government will still want Rosatom to finish the PAX 2 expansion. Meanwhile, European buyers have been signing agreements and memoranda with the province of Saskatchewan, with Cameco at the table, which looks very much like the groundwork being laid before a ban rather than after one. The practical effect of all of this is a market that keeps dividing. It was already split between East and West, and each incremental restriction deepens the split rather than resolving it. Western utilities are steadily removing supply options from their own list while their demand continues to grow. Compounding the problem is the inventory position. Chinese and Indian utilities have spent years building substantial strategic stockpiles ahead of their reactor construction programs, treating uranium as a security holding rather than a purchase order. American and European utilities have been considerably less aggressive in contracting, and they now face a narrower supply pool with thinner cover behind them. That combination of low inventory, shrinking optionality, and rising demand is not a temporary condition. And for investors, it argues that Western pounds from Western jurisdictions will command a premium that is not yet fully priced. Kazatomprom held another extraordinary general meeting recently, this one to approve the sale of more than half the book value of its assets to China National Uranium Corporation. It's the third such meeting in less than a year. The first covered a sale to a Chinese state entity, the second to an Indian one, and now a third. These meetings are required under Kazakh law, but the outcome is not seriously in doubt. The company is 71% owned by the Kazakh State Sovereign Wealth Fund, and a controlling shareholder rarely votes against a transaction it's already decided to pursue. The vote is procedure. The pattern is the story. That pattern is worth stating plainly. Kazakhstan is the largest uranium producer on Earth, mining close to 40 million pounds a year, and a growing share of that production is being contracted, sold, or committed to Asian buyers before it ever reaches a Western negotiation. The pounds are not disappearing from global supply, they're simply being spoken for at the source. For a Western utility, this is the part of the supply picture that does not appear in the headline production figures. Global output can look adequate, while the portion of it genuinely available to Western buyers shrinks year after year. When the biggest producer in the world is steadily redirecting its output towards China and India, the effective pool from which Western reactors can draw becomes considerably smaller than the total suggests. Investors should be watching not what the world produces, but who's already claimed it. NextGen Energy broke ground on its Rook I project last Thursday, and CEO Lee Cryer told Reuters that the company is sharing technical information and speaking regularly with BHP about the project. Asked directly whether these conversations involve a potential equity stake, Cryer neither confirmed nor denied it. What he did say is that BHP wants to weigh its portfolio towards politically stable countries, and then added, "Let's see where the future goes." NextGen needs to raise roughly $1 billion over the next 9 months, and it's weighing utility prepayments, debt, and direct project equity. Its market capitalization has doubled over the past year to $9.68 billion, which some investors think now makes it an expensive acquisition, even for the world's largest miner. But the more interesting fact is not the negotiation. It's that BHP has already purchased a large parcel of ground near Rook I, is building the world's largest potash mine elsewhere in Saskatchewan, and produces about 5% of global uranium supply as a copper byproduct of Olympic Dam. Incoming CEO Brandon Craig says he intends to take a serious look at uranium. That combination should register with everyone operating in the Athabasca Basin. A major with BHP's balance sheet entering the region changes the competitive landscape for Cameco and for Orano, whose Hook Lake project sits adjacent to this activity and is operated by PurePoint Uranium. Ground positions that are assembled patiently over decades become considerably more strategic when a company of that scale starts assembling one of its own. Competition for high-grade Athabasca ground, for skilled labor, and for permitting attention all intensify. What the investors should take from this is that the basin is being repriced by the arrival of new capital rather than by any single drill result. When the world's largest miner concludes that uranium in a stable jurisdiction belongs in its portfolio, the value of already holding that ground rises for everyone who does.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.